Most traders lose money for one main reason. They focus on price direction, but ignore liquidity. And liquidity is what actually moves the market. If you want to understand how institutions trade, you first need to understand how liquidity works, because every major move starts with orders being filled. In this video, I'll break down what liquidity really is, why large players depend on it, the main liquidity zones you'll see on the chart, and how you can start aligning your trades with institutional behavior instead of fighting it. Before we start, make sure you subscribe to the channel. I post clean breakdowns like this to help you understand how price actually moves. Now let's get into it. Let's slow this down for a moment. Liquidity is simply a pool of orders waiting to be executed. Every buy order needs a sell order. Every sell order needs a buy order. That never changes. The difference is size. Smaller participants trade limited volume. Institutions trade extremely large size. Because of this, banks and hedge funds cannot just enter whenever they feel like it. They need a large amount of opposite orders available at the same time. And where do those orders usually sit? Around stop losses and obvious entries. Stop losses are not just protection. They are pending market orders placed above highs and below lows. Institutions don't chase price. They guide price toward areas where those orders already exist. This explains something many traders experience. You enter a position. Price moves against you almost immediately. Your stop is hit. Then price moves exactly in the direction you originally expected. If that has happened to you before, this is why it's not manipulation in a dramatic sense. It's liquidity being absorbed. Price needed orders, and your stop provided them. Large players intentionally move price into areas where stops are clustered, where breakout entries are stacked, and where most participants feel confident. Once those orders are filled, price is free to move with real intent. Now, let's talk about specific liquidity zones. One of the most common and most visible forms of liquidity is equal highs. Equal highs form when price moves upward, loses momentum, and begins to consolidate. Multiple highs appear at roughly the same level. This creates the idea that price cannot break higher. Short positions start to build. Protective stops are placed just above the highs. Those stops represent buy-side liquidity. Institutions see this very clearly. Price is pushed slightly above the highs, those stops are triggered, liquidity is filled, and then price reverses lower. The key here is patience. You don't sell the highs. You wait for price to take them. Once the liquidity is absorbed, you look for rejection or displacement. You enter short after the sweep, place your stop above the highs, and target the previous swing low. Equal lows work the same way in reverse. After a down move loses strength, price begins to base. Multiple lows form at the same level. This looks like support. Long positions build. Stops sit just below the lows. That area becomes sell-side liquidity. Price is driven below the lows. Those stops are triggered. Liquidity is collected, and then price reverses higher. The correct approach is the same. Wait for the sweep. Observe the reaction. Enter after liquidity is taken. Place the stop below the lows. Target the last swing high. Now, this is where many people get confused, so pay attention here. Trendlines. Trendlines are not bad tools, but they are dangerous when used blindly because they are obvious, and anything obvious becomes a liquidity target. When many participants buy ascending trend lines or sell descending trend lines, price is naturally drawn toward those areas, not to respect them, but to collect orders placed around them. This is why trendline breaks and fakeouts happen so often. Now let's combine this with structure. Price moves in phases: expansion, hen retracement. When price breaks structure, it creates an imbalance between buyers and sellers. Institutions don't enter all at once. They leave behind areas of unfinished business. These areas are called order blocks. In bullish conditions, price breaks structure to the upside. The last bearish candle before that break becomes a bullish order block. Price retraces, and a trend line often forms. Many participants attempt to buy the trend line bounce. Institutional interest waits deeper. When price returns to the order block, liquidity is present. Orders are filled. Price reacts. Structure breaks again to the upside. The entry is not the trend line. The entry is the order block. You wait for price to return. Observe reaction and structure shift. Enter long and target previous highs. In bearish conditions, the same logic applies. Price breaks structure to the downside, confirming a lower low. The last bullish candle before the break becomes a bearish order block. Price retraces upward, and a descending trend line forms. Many participants sell the trend line or chase the breakout. Institutional interest remains patient. Once price reaches the order block and liquidity is available, price continues lower with strength. This is why understanding liquidity changes everything. Price does not move because of indicators. Price does not move because of patterns alone. Price moves because large orders must be filled. If you remember one thing from this video, remember this. Liquidity always comes before direction. Stop chasing obvious setups. Stop trading where the crowd feels comfortable. Wait for liquidity to be taken, and then align yourself with institutional flow. That's how real moves start. And if you want daily setups, live trade ideas, and more SMC education, join my private Telegram community. The link is in the description. Thanks for watching. Don't forget to subscribe and hit the notification bell so you don't miss the next video.